Most traders think that the ICT 2022 model is complicated, but the truth is it's actually a very simple checklist. The problem is nobody actually explains it in a way that you can repeat it every single day. So in this video, I'm going to break down the ICT 2022 model step by step, the exact way that I use it to trade live every single week. So by the end of this video, you'll understand what price is actually doing, what an A plus setup looks like, and why most traders still lose even when they think that they are trading ICT concepts. So let's build this model from scratch. Okay, so to start off, what actually is the ICT 2022 model? So essentially what it is a complete intraday trading framework built around liquidity, so liquidity engineering, market structure shifts, displacement and imbalance, and time of day execution. And the goal is to trade actual institutional order flow, not just random setups, not just that random market structure shift with the fair value gap, etc. So this is a model and a system. It's not just some simple strategy that is completely mechanic. You have to know and gain experience upon what you're doing in these markets. So now that we know what the model is, we'll answer the question of what is price trying to do. So number one, it's trying to seek liquidity above old highs and below old lows. So keyword liquidity, this is the thing that moves the markets. Every single market that you guys can think of, it's all built around liquidity. Then number two, it causes a shift in intraday market structure. So for example, price breaks above a specific high or a specific low within a price range. And then number three, it delivers price to the opposing side of liquidity. So if we have a framework that is bearish, we want to see buy side liquidity taken, and we're trying to seek a move that delivers price to the opposing side of liquidity. In this case would be sell side liquidity. So price is always moving from liquidity to liquidity. So now we'll get into the actual confluences of the model and the whole system and what you are looking for. So step one, daily bias. So you guys need to identify the daily liquidity target, or in other words, the draw on liquidity, whether it's buy side liquidity or sell side liquidity. Determine the premium versus discount of the daily range. So you'd simply get your fib on the chart and anchor it from the swing high down to the current swing low, and that is your current dealing range on the daily chart. And you are using the daily and the 4-hour structure to build a narrative to get your draw on liquidity. So your lower time frame intraday trades must align with the higher time frame draw on liquidity. So if you don't have a draw on liquidity or a higher time frame bias in mind, you are simply guessing the market. Right, step two, premium versus discount. So premium, you are simply looking for shorts, and discount, you are looking for longs. So to get your premium and discount, to know where you are within your range, you simply anchor your fib from the current dealing range as high down to the current dealing range as low, and anything above 50% of that price range is your premium, and anything below 50% of that price range is a discount. So smart money never goes short in a discount, and they never go long in a premium. For example, when you go into a store and you are looking for a pair of shoes, would you rather buy the pair of shoes at a premium price, or would you rather buy them at a discounted price? So would you rather buy a pair of shoes for $150 or $50 when they are on a discount? And then same thing for shorts. Would you sell your pair of shoes for a discount, or would you rather sell your pair of shoes for a premium where you actually get your money's worth? Same principle applies in trading. So with that being said, we only take trades when price reaches a discount for buys and a premium for sells. And let's say price is trading inside of a higher time frame discount of the dealing range and a sell setup forms. You simply do not trade. You want to simply wait for price to retrace back into a premium side of the higher time frame dealing range, and vice versa if you are looking to buy. Okay, step three, liquidity sweep. So we need a raid on session highs and lows, London lows, Asia highs, previous New York AM session highs and previous New York PM session lows, etc. Swing highs and lows, whether it's on the 15-minute, the 1 hour, the 4 hour, the daily, but think the higher time frame that you go, to anticipate a liquidity sweep, the more reaction, the better and more probable the setup will actually be. But if the liquidity sweep occurs on any time frame less than the 15-minute, for example, a 5-minute swing low or a 1-minute swing low, we simply do not trade those types of liquidity sweeps, because if price trades below a 1-minute low, are we really going to get the same reaction as if we trade below a 15-minute swing low? Also, majority of the time, the highest probability trades that you will find is from equal highs and equal lows in the marketplace, especially on the 15-minute, the 1 hour, etc. So this is the stop hunt that starts the move. Let's say you have built a higher time frame narrative and bias that we are bearish. You always want to anticipate some run higher that reads a point in buy side liquidity. So for a valid shorter form, you would want to see price take out London highs, Asia highs, previous day highs, and then anticipate your sell model. It would be vice versa for looking for buys. So no sweep means no trade. Okay, step 4, displacement. You want to look for an aggressive expansion after the sweep. So as soon as price takes out buy side liquidity, for example, you want to see a large aggressive move to the downside, and that is smart money tipping their hand to you that they have entered their positions. So what you're looking for is large impulsive candles, not just shallow wicks breaking below a swing high or swing low. You want to see large bodies of the candles, strong momentum away from the liquidity. So as soon as we take out buy side, you just want to see an immediate reaction. You don't want to see price start consolidating and then dump. You want to see an immediate dump to the downside, and that is your valid displacement. And for it to be a true valid displacement, it absolutely must have an imbalance left within the displacement leg. So again, just like I was saying before, the displacement simply confirms that smart money has entered the marketplace. Right, step 5, the market structure shift. So price must break an opposing structure after displacement. So this time I'll give you guys a bullish example. So as soon as we take sell side liquidity, you want to anticipate and you want to see a swing high broken to the upside with a displacement. So this signals that we have changed the state of delivery. So now instead of hunting sell side liquidity, the market is now actively seeking buy side liquidity. So the translation is market flips from buy program to sell program and vice versa, depending on which side of liquidity has been taken. Okay, now after the market structure shift, you want to see your fair value gap entry. So you want to enter on the retracement into the fair value gap created by the displacement, and then the entry time frame that you are looking for your fair value gap is the 1 minute to the 3 minute. So it could be the 1 minute, the 2 minute, or the 3 minute chart. And then your stop placement will simply be beyond the swing high or low of the displacement leg, or above or below the displacement candle, meaning candle number 2 of the bullish or bearish fair value gap. And your fair value gap is your institutional entry zone. So smart money, if they miss their entry right at the liquidity sweep, the fair value gap is their saving grace. That is where they will look for a re-entry. Okay, so step 7. Now, this is the most important piece of the model. You always need to see time of day first, because it's always time then price. So your primary trading window will be from 8:30 a.m. to 11 a.m. New York time, Eastern Standard Time. And the key times within that window will be at 8:30, which is when the news embargo and data gets released. Also 9:30 a.m. AST, which is your New York Stock Exchange open. And then 10 a.m, which is simply when the 4-hour candle closes and the 1-hour candle closes. So you'll typically see a lot of volatility around that time. And then again, time then price, not price then time. Highly specific times of the day where you are anticipating price to move. And then as for taking profits, you guys want to target internal range liquidity pools, internal highs, internal lows, internal bullish fair value gaps, internal bearish fair value gaps, session highs and lows. Again, London highs, London lows, Asia highs, Asia lows, and then external range liquidity. This is mostly where you will be targeting for your runners after you have taken a partial out of the market. And then as for your minimum risk to reward ratio, is going to be 1.5 to 2 risk to reward ratio. because if you somehow manage to get a 45% win rate with this model and you are only limiting yourself to taking profits at around 1R, then long term that is going to be unprofitable. Okay, and where exactly do you want to be taking partials? So ideally you want to be closing around 80% off of your position, or even 100% depending on how many accounts that you have. Obviously in the beginning phases of trading this model, ideally you just want to be closing 100% off of your position at internal range liquidity at around 1.5 to 2 risk to reward ratio. However, if you do have more accounts, then you can simply feel more comfortable by closing 80% at TP1 and then holding a runner to try and secure extra risk to reward ratio. So if you decide to take partials, it will be at internal range liquidity. Again, internal highs, internal lows, internal fair value gaps. Also recent swing highs and swing lows. And then as soon as you take a partial out of the marketplace, always move your stop loss to break even to essentially stop yourself from giving your profit back to the marketplace. And then you simply want to let your runner run for external range liquidity. Okay, runner's target, where will you actually be looking to take full TP with your runner if you decide to even hold a runner? So your final targets will be number one, external range liquidity from your current dealing range. Daily range expansion. Maybe there's a daily swing high or swing low that is near price that you may want to target. And also opposing session highs and lows. So if you're taking a sell, you want to be targeting London lows or Asia lows for your runner. And when the runner actually does hit final take profit, this is where the big risk to reward trades live. So here's the full simple 2022 model checklist. So number one, you must have your higher time frame liquidity target, your higher time frame bias and narrative. Number two, you want to identify where you are in terms of the premium or discount side of the dealing range. Number three, we need to see a liquidity sweep, nothing lower than a 50-minute liquidity sweep. So we must be looking for a 50-minute swing high or swing low or anything above, nothing below the 50-minute time frame for that. And then on the lower time frames from the 1 to 3 minute, ideally on the 1 minute, this is the time frame that I personally trade on the most. You want to see a displacement in the market. As soon as we take out buy side or sell side liquidity, you don't want to see price consolidate and then displace. You want to see an immediate displacement. And then the displacement leg must cause a market structure shift. It is fine if price wicks below or above that swing high or low. It doesn't need to be a full body closure. As long as you see a valid displacement in the marketplace, it's totally fine. And then within the displacement leg, for it to be a valid displacement, you need to see a bullish or bearish fair value gap, and that is where you want to enter from on the retrace. Also, again, time before price, you want to be trading during 8:30 to 11 a.m. EST. For you guys that prefer trading the New York Stock Exchange open, that is totally valid. You can trade from 9:30 to 11 a.m. EST. You don't have to trade from 8:30, but sometimes there will be moves that occur between 8:30 and 9:30, so just be aware that you may miss out on some setups. And then you want to be targeting the opposing side of liquidity. Buy side gets taken, you want to target sell side liquidity. If sell side gets taken, you want to target buy side liquidity. And then all of this right here, this checklist, this is the model, nothing else. Okay guys, so now we'll dive into a quick chart example just to show you guys what it looks like on the charts. So first of all, you want to start off on the daily chart and you just want to look at the key highs and lows in the marketplace, what liquidity has been taken and what liquidity has been left in the marketplace to be taken. Are we respecting bullish PD arrays or are we respecting bearish PD arrays? So you can see from the previous days we've had a run up on all of these clean highs up here, and if you look just to the left as well, we also have this unmitigated bearish gap that has now been mitigated. If you get the swing high to swing low on the higher time frame as well, anything above 50% is a premium. So now that we are in a premium side of the dealing range, we are focusing on shorts, especially now that we've taken out buy side liquidity within a premium side of the dealing range, and we've also mitigated this daily bearish fair value gap. And if you look even more to the left, we've also mitigated this daily bearish order block. So we can clearly see just by looking at this chart that we do have a bearish bias on the daily time frame. So now that we have our daily bias established, we now want to go to the 15-minute bellwether chart before the 8:30 open, and you just simply want to mark out the key highs and lows that are near price, specifically the highs, because if you have a bearish bias on the higher time frame, you want to always align your lower time frame ICT 2022 model with that higher time frame bias. So we've got a bearish bias on the daily time frame, we want to have a lower time frame bearish setup. So we'll go ahead and mark out all of the key highs that are on your price. Notice how I'm doing it on the 15-minute as well, not just the 1-minute chart. So we've got London high, we've got these pre-market highs as well, pre-8:30 open. So again, anytime price is going to move significantly lower, you always want to anticipate a price move on buy stops. You always want to see that manipulation before you get the dump. Also on the 15-minute, we'll mark out the 8:30 open. So anything after 8:30 open, that is where you can start hunting for setups and hunting for buy side liquidity. So we'll go down to the 1-minute. Now all you're looking for after 8:30 is just a run on one of these highs, even just this one right here will do. So now on the 1-minute, you're just looking for the key highs that we have marked out on the 15-minute. You just want to anticipate an ICT 2022 model to form for a bearish setup, as we do have that higher time frame bearish bias. Also notice on the daily, we are still trading inside of this daily ICT bearish fair value gap. That's in a premium side of the dealing range. Just a little bit extra confluence behind this short if we do get the model. Okay, so I'm going to forward price here. So we've taken out this buy side liquidity. Do we get a market structure shift lower? No. So it's still waiting patiently, and then boom, we take out this internal high after taking out this higher time frame high, and then we get your ICT bearish market structure shift. Do we get a displacement? Yes. Why is it a displacement? Because we have a clean ICT bearish fair value gap. We'll also have a clean volume imbalance right there as well, just above the bearish fair value gap. So you'll mark out your fair value gap, and as soon as price retests the fair value gap, that is where you want to go short. Stop loss is going to be at the high of the displacement leg, and you just want to be targeting internal range liquidity for full TP. So a key thing with taking full profits, or even if you want to take partials, you always want to mark out the swing high down to the swing low of the current dealing range. So I'll take the swing low from here with the Fibonacci to the recent swing high of the displacement leg, and anything below 50%, that is where you want to target, because if we're going short in a premium, you always want to be targeting a discount. I'm not going to target this fair value gap because it overlaps with a discount and a premium. So I want to target this low down here because this is the first swing low inside of a discount side of the dealing range. And again, you can already see the type of risk to reward ratio that this model offers when you align the higher time frame with the lower time frame. So now that we are in the trade, we'll see how the trade plays out. Okay, boom, that would have been final TP hit after around 10 minutes of trading. That would have secured you, if you took full profit there, around 4.41 risk to reward ratio. And let's say, for example, you just decided to close around 80% off of your position there and hold a runner for external range sell side liquidity on the higher time frame. You would just simply go break even on this trade right there after taking TP1, and you would look on the higher time frame for higher time frame targets. So we can see the sell side down here. We can also see this external range sell side liquidity as well, which is a key swing low. Obviously, if you look on the 15-minute, your eye will be drawn down towards this key low right here. So we'll leave a run out down to there and see if the market wants to come down and take these lows. Obviously, we've got the bearish bias on the day. We've taken TP1 and we are break even. So even if price was to retrace back and take us out at break even, it does not matter, simply because we have already taken money out of the marketplace. So with that being said, we'll go ahead and see how this trade would have played out. Okay, and boom, TP smashed. So even on this trade, if you had have held a runner, you would have secured even more risk to reward ratio, potentially even up to 6R. Now, I know that sounds insane, but it just goes to show you that it's not going to happen all of the time, but when the runners do run, they absolutely run. Now, obviously, you're not always going to hit swings like this every single day on the charts. You've simply got to stay patient and wait for the opportunity to present itself for you. So notice how this was a short and I've aligned it with the higher time frame bearish bias. Now, as I say, always, if you align your lower time frame with the higher time frame bias, you always will get moves like this when they do tend to run. And also notice how I was not focusing on longs going into the day. I was focusing on shorts simply because we have that higher time frame bearish bias. So if we have a bearish bias, you are never ever looking for longs. You are only looking for shorts. And that rule alone saves you from a lot of mid trades and a lot of stop outs. All right, that's it for today's video. If you want to see me actually execute this model live in the markets every single week, you can watch me trade it in real time inside of the Blackout VIP Discord. We do live sessions, trade breakdowns, and I show every single win and every single loss. No hiding and especially no hindsight. Everything done live on the charts in front of you guys. So if that sounds like something that you'd benefit from, the link to join is in the description of the video. Appreciate you lot for watching, and I'll see you lot all in the next one.